In this video, we are going to discuss what is the average true range and how can you use it to improve your trades. Okay, let's first discuss a formula. The formula is the maximum of. So we have three conditions here, and the maximum of them will be the true range. So the first condition is today's high minus today's low. So what is the maximum price of today and what is the lowest price of the day? Okay, so this is the first condition. The second condition is today's high minus yesterday closing. Today's high minus yesterday closing. All right. The third one is today's low minus yesterday closing. So the maximum of the three of these conditions will be the true range. This is what we call the true range. Okay, let's take an example to explain this. So let's assume that today's high was 225 and today's low is 215. So the current high, the first condition is current high minus current low is 225 minus 215, which is 10. The second condition is current high minus previous day close. So current high is 225. Yesterday close we assume is 218, then this minus 10 is 7. The third condition is the current low minus the previous close. So let's assume the current low is 215, previous close was 223. So the current low minus the previous close is 223 minus 215, it is 8. And take care about one thing, it is always positive. So regardless what is higher, what is lower, is the absolute change in value. Okay, so these are the three conditions. Now let's choose the maximum of them. Which one is the maximum of them? Of course, it is the 10. And that's how the true range is calculated. So basically, what is the true range is measuring? Is measuring the volatility of the stock versus today and versus yesterday. It always takes into account today and yesterday. And it picks the highest of the three values. The highest of today's high minus today's low, and today's high versus yesterday close, and today's low versus yesterday close. Now, what is the average true range? It's basically the average of the last 14 days. The average of the last 14 true range in the last 14 days, it's called ATR 14. So the ATR is basically the DNA for the stock. It gives you the character of the stock, and it gives you the normal variation of this stock versus today, how much it fluctuates today and how much it fluctuates versus yesterday close. A high ATR means high volatility, and a low ATR called a low volatility. And we normally represent this in a percentage of the stock price. Now you might have heard about what is called ADR, average daily range. This is basically just one element. It is the daily change, the highest minus the maximum. So I like to use the ATR. It is giving me not only the daily change, but the daily change, and it's comparing today's versus yesterday as well. So if there is a gap up, gap down, it also gives me that because it takes the maximum of today's change and the maximum of the high of the day and the low of the day versus yesterday close. That's why I like the ATR versus the ADR. Okay, now we understood the formula and what do you mean by average true range. Let's see how can we use it. I'll give you 5 usage of the ATR. So this is the first use of the ATR, which to decide on the stop loss. Stop loss is very important. There is no trader that is trading stocks without a stop loss. You're doing anything else other than trading if you do not use a stop loss. So the first one is to decide on the stop loss. And we always say the stop loss should be bigger than 1 ATR, preferably 1.5 ATR. Why is that? Let's assume that you use a stop loss of less than 1 ATR. What will happen? We are saying that the ATR is the variation of the stock during the last 14 days. So it is going to change by the ATR based on the last 14 days average. So if you choose a stop loss that is below 1 ATR, it means that you are going to go out in one day because your stop loss is very tight. Okay, let's take an example on this chart. This is GE. The ATR of GE is 5.1. which is about 2%. All the famous chart sites will calculate for you directly the ATR 14, and you can change it to make it ATR 21 or ATR 50 based on what you like. But we normally use the ATR 14. So you don't have to do any calculation and get the maximum and do any Excel sheet. It's all calculated to you automatically. If you just go to, for example, I'm using Yahoo Finance here. You go to Yahoo Finance and you add indicator and you add the average true range, and the default is 14. So you add it to the chart and it will appear here to the chart that the ATR is 5.13. You always go and choose the maximum to the right, and it is 5.13, which corresponds to the day closing. So at today's closing, the closing of that day was 255, and the ATR was 5.13, which is about 2%. So the ATR is 2% of the value. It means that the average change of this stock over the last 14 days is 2%. So in this case, for example, you cannot use a stop loss which is less than 2%. Why? Because if you use, for example, a stop loss of 1%, you will go out automatically in one day because the average volatility of that stock is 2% per day. Recommendation is to use 1.5 ATR. So for example, here, if you calculate the 1.5 out of 5.13, the stop loss should be at least 3%. In this way, you guarantee that you are not going to be kicked out of the stock in 1 or 2 days. Okay. Let's take another example of a stock called SMR. The stock value is about 34.3 at that day, and the ATR was 2.8. If you divide the ATR over the stock price, you will see that it's about 8.1. You cannot use here 2 or 3% as a stop loss, because if you use that, you will go out instantaneously because the stock movement is about 8% in one day. So if you are going to choose a stop loss for this stock and you use a 1.5 ATR, then your stop loss will be placed 12% away from the purchase price. And you can see that your loss here will be 12%. So if you cannot tolerate a 12% stop loss, don't go to high ATR stocks. And this is leading us to the second usage of the average true range, is to select stocks. So if you are a low risk trader and you would like to keep your stop loss at minimum, then you use low ATR stocks. Like General Electric, for example, we've seen that the ATR is 2, the 1.5 ATR is 3%, then you use GE. This is more suitable. If you go to SMR, and you will use a stop loss of 8%, which is very, very high. The 1.5 will be 12%. It's going to be very high for you. So this is only recommended for the high risk trader. So the high risk trader can select the ATR that's typically above 4%. The low risk trader select the ATR which is less than 4%. The third usage of the average true range is to decide on your position size. The general rule is never risk more than 2% of your account in one trade. I'm talking here about your account value. For beginners, the risk should maximum be 0.5%. I normally use 0.5, 1%, despite I've been in this field for more than 20 years. Let's take an example. Let's assume that you have an account size of $10,000. Let's assume you are going to use a 0.5% risk factor. Then your maximum risk that you can take in this account is 0.5 multiplied by 10,000 is $50. This is a maximum risk that you can take per trade. So how can you decide on the position based on the risk size? So the formula to apply here is that the percentage of the position size from your total position equal to the account risk over the stop loss. So let's take GE as an example. The account risk, we agreed that it will be 0.5%, and the stop loss will be 1.5 ATR, which is 3%. If you divide the 0.5% over 3%, it will give you 16.7%. That's the position size that you can afford to have in GE. If you go to SMR, we keep the same account risk, which is 0.5%. But here, the 1.5 ATR is 12%. If you divide 0.5% over 12%, it will give you 4.2%. This is the maximum position that you can have from SMR. So as you can see, if your risk is low, then your position is going to be big. And if your risk is high, your position is going to be small. In both cases, the risk is only 0.5%. And that's how you can decide on the position size using the average true range. Moving on to number 4, we use also the average true range to increase the position size. So this is about a very nice story about two famous, well-known traders in Wall Street that had a discussion together about, can you teach stocks trading or you're born with this gift? One of them said you cannot teach this, you are born with it. One of them said you can teach it, and they both struggled to find an answer. So they decided to do an experiment. They hired 23 beginners and they gave them the same system that they were trading. And guess what? All of the 23 beginners had the same result as these two guys was achieving. So they found out that trading can be taught. Very nice story. And these are called the turtles. They become one of the best traders in Wall Street. The trader system was to increase the position size every 0.5 ATR. So let's take GE as an example. The current price is 255, 1 ATR is 5, 0.5 ATR is 2.6. So if the stock increased by 2.6, they add a position equal to the initial position that they started with. So let's assume that the stock price increased by another 2.6, then they add another position equal to the initial position that they added until they reach the maximum of 4 times the initial position. Okay, so that was the fourth use of the average true range. The fifth use of the average true range. In a bull market, normally you go for high ATR stocks. Why? Because the probability that you are going to make money in a bull market is much, much higher than you are going to make money in a bear market. So it's recommended in the bull market that you go for high ATR stocks, and in the bear market you go for low ATR stocks. If you follow this rule, you will find yourself that in the bull market you are able to beat the market. That was it. I hope you enjoyed this video. Again, this video is for educational purpose only. If you like the video, please press like, subscribe to the channel, and share it with your friend. And thank you very much. This was Ahmed Saleh.